We're opening today's broadcast with a story that cuts straight to the heart of central bank independence in America. Federal Reserve Governor Lisa Cook has disclosed more than $1 million in legal and security expenses tied directly to the Trump administration's attempt to remove her from office. That figure comes from a financial disclosure filing made public today, and it is not an abstraction. It is a documented, out-of-pocket cost borne by a sitting Fed official for simply attempting to keep her job. This is not routine. This is the first time in modern Fed history that a governor has had to publicly quantify the personal financial toll of resisting executive removal pressure. The financial disclosure filing confirms that Governor Lisa Cook incurred over $1 million in combined legal fees and personal security costs as a direct result of the White House's effort to oust her. These are realized, documented expenses, not estimates or projections, representing money already spent defending her tenure at the Federal Reserve. Cook is a voting member of the Federal Open Market Committee, and her seat carries enormous weight in shaping U.S. monetary policy. The filing makes no ambiguity about causation. These costs are explicitly attributed to the Trump administration's removal bid, making this a matter of institutional record, not political rumor. The Federal Reserve's independence from the executive branch is not merely a legal tradition. It is a foundational market assumption priced into every Treasury bond, every equity multiple, and every currency trade involving the U.S. dollar. When investors buy U.S. assets, they are implicitly trusting that monetary policy will be set on the basis of economic data, not political preference. What Cook's filing exposes is that this trust is no longer hypothetical. It has been actively tested and contested. The 10-year Treasury yield sits at 4.43% today, down sharply, but yields could reprice rapidly upward if markets conclude the Fed's inflation-fighting credibility is politically compromised. That scenario carries systemic implications. Right now, markets are choosing to treat this as a contained story. The S&P 500 is up 0.72%, the Nasdaq 100 is surging 2.02%, and the Russell 2000 has added modestly. Risk appetite is intact, and the VIX has declined significantly, dropping by 7.54%. But that calm comes with a caveat. Technology's rally in the Nasdaq 100 is directly supported by falling rates. The 10-year at 4.43% is a tailwind for duration-sensitive growth stocks. Any escalation in the Cook situation that erodes Fed credibility would push yields back up, compressing tech multiples sharply. Financials via the financial sector face dual-sided exposure. Rate clarity uncertainty is never good for lending spreads. Defensives like utilities and consumer staples would likely outperform in a flight-to-safety rotation if this story widens. There are 4 concrete levels traders need to anchor to right now. The 10-year Treasury yield at 4.43% is the linchpin. A break below 4.3% would signal genuine fear of policy instability, driving a bond safe haven bid. The VIX at 17.05 remains benign, but a push above 20 would confirm that political and Fed governance uncertainty is being repriced into options markets. The S&P 500 near 29,500 has support near 7,400. A breakdown there would be technically significant. The dollar index at 100.63 is the wild card. A sustained break above 101 would suggest foreign capital is seeking USD's safe haven status despite domestic political risk, which is a paradoxical but historically documented phenomenon during U.S. institutional stress events. The single most important variable here is whether Cook's disclosure remains a one-time filing footnote or becomes the first chapter of a broader narrative about executive encroachment on the Federal Reserve. If it stays contained, the current market setup, a falling the VIX, a tech-led Nasdaq rally of 2.02%, and 10-year yields at 4.43%, remains fully intact and you stay long growth. But if additional governors face similar pressure, or if congressional hearings amplify this story, the risk-off repricing could be swift and unforgiving across the S&P 500, the Nasdaq 100, and credit markets simultaneously. Watch for follow-on statements from Fed Chair Powell or other board members as the real escalation signal. That's the full picture on the Fed independence story today. Coming up next, a separate market-moving development that every bond and equity trader needs on their radar right now. Shifting now from macro crosscurrents to a consumer story that is quietly reshaping the retail landscape heading into the back half of the year. A new survey from the Human Rights Campaign reveals that LGBTQ+ consumers are actively reallocating their spending away from retailers they perceive as having retreated from Douglas Emmett commitments. The brands named most prominently are Target, Walmart, and Amazon, three of the largest consumer-facing companies in the United States. This is not abstract reputational noise. This is a stated preference shift from a purchasing cohort that has historically been among the most brand loyal in retail. The question now is whether stated preference becomes documented spending loss by the time Q2 earnings arrive. The Human Rights Campaign, one of the nation's largest LGBTQ+ advocacy organizations, published survey data showing that LGBTQ+ consumers are consciously moving their wallet share toward brands they view as maintaining or strengthening Douglas Emmett commitments, and away from Target, Walmart, and Amazon specifically. The survey does not quantify total dollars redirected, but the directional signal is unambiguous. These retailers are perceived as having stepped back from prior Douglas Emmett positioning, and their shoppers are responding. Also named in the orbit of this story are Costco and McDonald's, two brands that cut across the mass market and quick service segments. This follows a broader wave of corporate Douglas Emmett rollbacks that accelerated through late 2025 and into 2026 under shifting regulatory and political pressure. The deeper driver here is the monetization of cultural polarization. For years, analysts treated Douglas Emmett positioning as a reputational variable, something that affected brand equity in surveys but rarely showed up in same-store sales. What the HRC data suggests is that the politicization of corporate Douglas Emmett has crossed a threshold where it is now influencing actual purchase decisions, not just sentiment scores. LGBTQ+ consumers represent a demographically concentrated, higher education, higher income cohort that indexes heavily toward discretionary and premium retail. Losing even a fraction of that cohort's loyalty hits the higher margin segments of the basket, exactly the segments that Target and Walmart need to defend as they compete on price against each other and against Amazon's convenience mode. Let's be specific about the exposure. Target is the most vulnerable name here. It built years of brand equity with LGBTQ+ shoppers through Pride merchandise and inclusive marketing, then visibly scaled back that commitment, creating a trust deficit that this survey is now quantifying. Walmart faces mixed signals. Its price leadership positioning attracts all income cohorts, but Douglas Emmett perception erosion could pressure the higher margin customer segments it needs for mix improvement. Amazon has AWS and advertising to insulate it at the earnings line, but consumer loyalty scrutiny could weigh on retail segment valuation multiples. Costco's relative silence on Douglas Emmett rollbacks may actually be a comparative advantage here. The consumer discretionary ETF consumer discretionary faces a diffuse headwind if multiple large caps acknowledge the trend simultaneously. The concrete catalyst to monitor is Q2 earnings, due in late July through August 2026. Same-store sales figures for Target and Walmart will be the first hard data point that can either validate or deflate the HRC survey's directional warning. Watch especially for management commentary on traffic patterns across demographic cohorts. Any acknowledgement of LGBTQ+ shopper attrition would be a significant signal for Q3 guidance revisions. For Amazon, the watch is on Prime membership retention and discretionary GMV. Separately, monitor whether any specialty retailers or direct-to-consumer brands with explicit Douglas Emmett positioning begin reporting better-than-expected traffic. That would confirm the wallet reallocation thesis is real and quantifiable, not just a sentiment artifact from a single advocacy survey. The bottom line is straightforward but nuanced. The HRC survey is a leading indicator, not a lagging one. And leading indicators in consumer sentiment have a mixed track record translating into earnings line damage without corroboration from point-of-sale data. What makes this one worth watching is the specificity of the named retailers and the historical brand equity these companies built with LGBTQ+ shoppers before rolling back. The risk is asymmetric. If Target or Walmart's same-store sales miss in late July and management cites softness in discretionary categories, this survey will look prescient. If spending patterns hold, the story fades. Those are the two stories driving markets today. Full breakdown is up and the deep dive continues below. If this kind of analyst-depth daily market coverage is what you need, hit subscribe and turn on notifications so you never miss a breakdown. Every trading day, we go deeper than the headlines, tickers, levels, catalysts, and the real macro context. See you tomorrow.